Hello, you're watching the business headlines on HW News with me, Ali Azhar. PSU banking major Punjab National Bank or PNB said it has detected a fraud of more than 3,800 crore rupees by Bhushan Power and Steel Ltd and has reported it to the RBI. In a regulatory filing filed by PNB, it said that on the basis of a forensic audit conducted and an FIR being filed by the CBI, it had detected the fraud and promptly reported it to the RBI. PNB has accused Bhushan Power and Steel and its directors of misappropriating bank funds and manipulating books of accounts to raise funds from a consortium of bank lenders. A breakup of the total exposure that PNB has to Bhushan Power and Steel looks something like this. Its domestic exposure stands at 3,192 crore rupees and its overseas exposure at 346 crores at the Dubai branch and 268 crores at the Hong Kong branch, which totals 3,805 crores. The lender added that it has already made provisions to the tune of 1,932 crores as per RBI norms and further added that the case is presently with the NCLT and the bank expects a good recovery in the account. The second largest state-run bank has reported a new fraud at a time when it is just recovering from the 3,400 crore mega banking fraud perpetrated against it by diamond merchants Nirav Modi and his uncle Mehul Choksi a little more than a year ago. Shares of the bank ended 11.25% lower in reaction to these allegations, ending today's trading session at 72.60 rupees per share. One of the most talked about budget proposals that Finance Minister Nirmala Sitharaman seeks to impose is the additional surcharge on individuals earning in excess of 2 crore rupees a year, commonly called as the super rich tax. Just to clarify, a surcharge is a tax on tax and is levied on the amount you are liable to pay. Friday's budget proposal will raise the effective tax rate for two categories. Now, individuals earning annual income between 2 crores and 5 crores to whom the highest income tax slab rate of 30% is anyways applicable will have to cough up a surcharge of 25% on their income, in addition to the already existing cess of 4%. This would take their effective tax rate to 39%. And for individuals earning above 5 crore rupees income a year, surcharge of a whopping 37% would be applicable, in addition to 4% cess. This would attract the highest effective tax rate of 42.74%. This additional tax on the super rich was justified by the finance minister with the intent of revenue mobilization and the fact that those in the highest tax bracket should contribute more to the nation's development. Besides, it's in line with India's philosophy of tax the rich to pay for the poor. But we're asking the question, is this additional revenue worth the risk it brings with it? When I say risk, I mean the damage to investor confidence and the message it sends to the rest of the world that tax structures in India are not too friendly when it comes to the ultra wealthy. Besides that, the super rich then start looking for other avenues, such as loopholes to avoid paying tax, and even worse, relocating to other countries with more tax-friendly governments. Around 40,000 individuals filed returns with income in excess of 2 crore rupees, and the surcharge on the super rich would help garner an additional 12,000 crore rupees. Still, in spite of these figures, it's hard to justify the effect on business confidence. Justifying raising of tax on the super rich, the finance ministry said the highest tax rate in India was still lower than in many countries, including the US and China, and it was a worldwide phenomenon to ask the super rich to pay extra tax. However, the fact of the matter is that countries which have high individual tax rates are developed countries, and the services which they offer to their citizens in return and the general quality of life that one can expect in those countries are far better than what we are used to in India and justifies the additional tax structures. So, let's take a look at how India racks up against other countries with high individual tax rates. As can be seen from the table, Canada has the highest tax rates from the sample selected by us at 54%. This is followed by the United States, which taxes its ultra-wealthy citizens at 50.3%. India is followed by China and the United Kingdom, which impose a tax of 45%. Singapore has the least taxation structure for its ultra wealthy, coming in at a measly 22%. What is also important to note is the threshold over which the maximum effective tax rate applies. And in that department, India has done the best. The maximum tax rate applies only if individuals earn in excess of 5 crore rupees. Where, if we take the example of China, their super rich individuals have to pay a tax rate of 45% if their income exceeds just 96 lakh rupees in a year. Let's now take a listen in to what our business and finance editor, Mr. Akhilesh Bhargav, makes of the proposal to impose an additional tax on our super rich. Over to you, sir.
At a time when India's economic growth rate has been going down and tax collections have been uncertain and even their growth rate has been going down, at such a moment, the government needs to look out for raising revenues. In this budget, the middle class has been spared. No increase in tax rates, no decrease either. But it is the super rich, as we call them, who are now going to be taxed at much higher rates. An increase in surcharge has been proposed for those who earn between 2 to 5 crores, such that their tax rates will go up by 3%. And for those who earn upwards of 5 crores, their tax rates will go up by 7%. That is a very steep rise. What is the kind of income that the government expects to get from this additional surcharge being levied on the super rich? Back of the envelope calculations say that in India, there are about 40,000 individuals who file income tax returns with an income over 2 crores. Those are the number of persons who are going to bear this burden, and these very calculations say that the government hopes to garner additional tax resources to the tune of 12,000 crores a year by virtue of this additional levy in mind. Now the issue that really comes is, it is true that there are many other countries where the tax rates on individuals are higher. That is a fact. But the fact also remains is that if these are developed nations, like Japan has a higher tax rate, Spain has a higher tax rate, Switzerland for certain individuals has it, you are trying to compare the tax liability with those countries where a person would not mind paying a higher tax rate because he gets a better quality of living in those countries. So tax rates are higher in other countries, but those countries, by virtue of their development and the standard of living that they provide to the individual, they are not truly comparable with us in India. That's one point. The second point is that if the tax rates have gone up by this measure, then what will prevent these super rich from relocating abroad? There is anyway a trend of millionaires migrating from India, and probably with this kind of a levy coming in, their migration out of India will only get accelerated.
Thank you for watching HW News. This is me signing off. Have a great day.